Hello, everybody, and welcome back to the Dash Trader Newsroom. And today we're going to be talking about, is the stage set for the summer rally? And we certainly had a nice little move off the lows already. My name is Michael DeJoyer. I'm the Director of Educational Services here at Dash Trader, and I'm joined by Jill Malandrino, Global Markets Reporter from Nasdaq. Jill, how are you?
Doing good. Thanks for having me.
Great. So we've had a couple of earnings reports so far. We had some mixed results from the banks. Certainly, we've had Netflix, which was an interesting one, which they were up. They had been down massively in the past, but they were certainly up on losing less subscribers than they expected, which is always an interesting take on things. So what do you expect for the remainder of earnings season? We're really getting into the heart of it now. I mean, this is really the main chunk of the big corporations of the United States and the world. What do you expect from the remaining of the earnings season?
Well, you're certainly right, Mike. Next week, we'll have the large cap global heavyweights in the Nasdaq 100 all reporting. And I think to the theme of not as bad as expected or not as good as expected really is going to be what the theme is here. I guess the overarching question is the bad news priced in? And if we take a look at some internal indicators, and we'll talk about that in a minute. Companies are getting rewarded if they have not underperformed their earnings expectations, and I really think that's what the theme is going to be here. We know there's supply chain constraints. We know we're in a rising interest rate environment. We know we have to worry about geopolitics. We know there's inflation. This is nothing new. So yes, in terms of what happens with guidance moving forward, that will. It's not like we haven't spoken about this, but we will see how, from an operational perspective, how management teams are adjusting their strategies. I also think this week with companies like Apple coming out, with Google coming out, I'm not sure if that the company confirmed on Apple, but Bloomberg reporting that Google coming out that we have hiring freezes. We are adjusting our spending on growth for 2023. So they're anticipating a softer economic environment, but they're at least adjusting their business models. So it seems as if the Band-Aid has been ripped off. The news is out there, and I feel like the type of action that we saw this week, particularly in large cap growth Nasdaq 100 names, is reflective of that.
Yeah, absolutely. So we've definitely seen companies starting to adjust to the potentiality of maybe a softer economy and potentially even a recession in 2023. We did get a very, very soft or increase or high jobless claims, showing that this is the 8-month high in jobless claims that came out earlier today. Our higher interest rates starting to form and cause demand destruction. Are people starting to be laid off and lose their jobs? What's really more important, and this is the crazy part, is what is the Fed going to make of all this? Because the next thing we're going to be talking about is the Fed and next week's interest rate decision. Because sometimes, and this is very confusing to lay people, sometimes bad is good and good is bad in the financial markets, in that if the Fed thinks that jobless claims are high, they may not raise the rates so much. They might try to engineer this soft landing. So maybe they'll only give us a 50 basis point raise. Or they'll say, okay, jobless claims are already high, and we want to kind of slow things down, or whatever. It's sometimes very confusing for people to figure out how the Fed is going to interpret this data. So what are your thoughts?
Yeah, it's interesting. We'll find out next month if we are technically in a recession, but what makes it confusing is the labor market is still tight, right? We're south of 4% in terms of unemployment rate. Housing market is softening, but not falling off of a cliff. We are hearing about hiring freezes and some job cuts, and it's not like your classic recession like we saw in 08, 09, where everything was cratering at once. So it almost feels as if the economic reset, if you will, almost like what we saw with stock valuations, is in the process of happening right now. I mean, think about the amount of hiring that was done in 2021 when money was cheap. There was so much demand out there, particularly in the tech space. And when you hear about freezes and cuts, it really has been more focused in the tech area. There was a number of people in the services space that moved over to the tech area. So they're just resetting expectations. It's no surprise that we've heard about the great resignation over the past 2 years. So it's more of the labor market readjusting with the high demand of employees and the surplus of jobs that were available for employees. So it feels as if everything is normalizing. I'm not sure if that's necessarily specific to Fed policy. However, what happens in the labor market will influence Fed policy. So I think it's just more of a reset, and a lot of companies doubled, tripled their workforce over the past 2 years. I mean, it's kind of crazy when you think about we're in the middle of a pandemic and how much wealth was created, right? When you saw what the stock market did, how much money was, liquidity was just flushed into the system, and now it's being retracted to a certain extent, and the economy is going through a slowdown.
Yeah, so the three things the Federal Reserve looks at, right, is number one, they look at the inflation numbers, right, consumer price index, right? That's what one of their key metrics is. The other thing they look at is jobless claims and employment, right? They want to see that the economy is near or close to full employment. And of course, the other thing that they're just looking at, they're supposed to be impartial from and not really concerned with some of the things like let's say the performance of the stock market. So from my perspective anyway, it looks like the Fed may be a little bit less inclined to raise a full 100 basis points, right? They're probably more inclined to do 50 or 75 based on the higher jobless claims that we've seen lately and the continued persistence in inflation. At least that's the way that I'm kind of looking at things. Now, the next question, and this is exactly what our slide is about, is final interest rate decision of the summer is next week, right? We've already talked about it could be 50, 75, or 100. Looks to me like we're pricing in a 75 basis point. I mean, that's the middle of the range. That's the center of the bell curve where most people are thinking that they're going to come in at. But the question is how does the market deal with, let's say the Fed gives us a 50 basis point rate hike? Does the market look at that as the Fed not being tough on inflation? 75, I think, is the sweet spot. And I think the market could then potentially trigger a summer rally, meaning that the Fed is doing as expected. They're dealing with inflation in a pretty stringent manner, but they're not shying away from their obligation, so to speak. What would the market's reaction be to a 100 basis point move, which may be what's necessary to get inflation in check? So what are your thoughts on the 50, 75, 100 basis point discussion?
I think it's going to be, to your point, somewhere in between, certainly at 75. I know 100 basis points was part of the narrative, but I think it would be a bit aggressive and I think somewhat of a shock. So I think 75 basis points somewhere in the middle makes more sense. Interest rates were positioned for tighter monetary policy. Of course, are being adjusted with the possibility of recession. And I think even if we do experience a contraction of some sort of self-fulfilling variety, I'm not sure if it's enough for the Fed to pause. I mean, after more than a decade of erring on the side of inflation, the current pricing environment necessitates policy erring on the side of contraction. I mean, it's been 13 years that we've had such an accommodating environment when it was unnecessary to a certain extent, or we didn't have to be as loose as it was. I think part of the concern is you see the yield curve is inverting again. That's the first time in April with some of a warning, but that was very short-lived. Perhaps this instance can be viewed as a signal. So I think whether or not the fundamentals of employment and household balance sheets justify recession, as we were talking about before, when you think about confidence surveys and supply constraints, it could suggest that one is upon us. And again, we'll find out next month if technically we are in one. Like we had mentioned earlier, it wasn't like 08, 09, or other previous recessions where everything was contracting in lockstep with each other.
Yeah. So again, the industry definition is economic contraction for 2 quarters in a row. We've had 1 quarter of economic contraction. So now we're going to find out whether or not we've had another quarter of economic contraction, and then this would officially put us into recession territory.
Right.
That's from GDP numbers, right?
Mhm.
So we're going to find out if the economy has shrunk for an entire half a year, which would be a recession. But the yield curve, which you mentioned as well, that's a little bit of a different story, because the yield curve generally indicates that a recession is coming.
Mhm.
Now, the difference about this than what April was like a little dip in an inversion, right? It was a dip into an inverted yield curve. This time, we've had a full plunge into an inverted yield curve.
Yeah.
And I think that's usually an inverted yield curve, although economically speaking, says, you don't necessarily have to, but it has been a very, very highly accurate indication of some very big economic turmoil, usually within a year or 6 months to 18 months from the inversion, right? Isn't that the general,
Yeah.
like, it's a bit of a delay.
It is, and you're absolutely right. It typically does signal. I mean, historically, that's what it showed anyway. And the GDP print is going to be important because, as we know, the consumer is nearly 70% that contributes to it. And we are seeing, again, a contraction in savings. Spend hasn't necessarily slowed down, but that spend is coming from savings. We're seeing people use credit card utilization more, as the cost of inflation is just, making people have to pay beyond, the income that's coming in, certainly not by fault of their own. But the fact of the matter is that savings have contracted and credit card utilization is moving higher, and something is going to give at that point, because then you have to start questioning, okay, can mortgage payments be made? Will bankruptcies rise? Will credit card delinquencies rise? So, while it's not necessarily a bad picture right now, it is something that you do want to think about those contraction details as we look out.
Yeah, so those would be real indications of some serious demand destruction once you start to see those numbers start to pile up. Well, I hate to leave it on a gloomy note, but it does, at least for the short term, if the Fed does not raise more than 75 basis points, it does look like, at least for the short term, the stage may be set for a summer rally. The market technically has put in some good lows, some solid lows, and if the earnings continue to be decent, that there is a possibility of that. And I think that one big thing that the market and financial participants are all looking at is that, once the Fed is out of the way, that's one less thing for us to worry about, whatever the Fed decides, right? So on that note, thank you so much, Jill.
You got it. I will see you in a couple of weeks.
See you in 2 weeks.
Take care. Have a good rest of the week.
Thank you so much, Jill.
See ya.
All right, that brings us over to the market analysis. And I'm just going to switch over to the charts here. Here, I got my Dash Trader. We've had a pretty bullish day. We've continued in that, it's coming into the end of the day. Market just closed here. It's 4 o'clock on Thursday. We closed up near the highs, off the lows of the market. Okay, and it looks like the next resistance level is somewhere around 410. This is our weekly chart. This is 410 on the SPY weekly. And, this is a really, for the week to close out above this 395 resistance level, that would be extremely bullish from a technical perspective. Now, I do want to point out that the point of control is up here at 435 on the S&P, SPY. Let's take a look at the DIA. Pretty much the same picture. I'm going to pop this into the daily chart. The big resistance level on this is right here at 330. Okay, 330, from 320 to 330, there's a big level up, big move up. You know, we need to close above really where we are right now at anywhere above 320, 319, 318. If we close above that level, that would be extremely positive for the bulls for this week. This very much looks like a low, lower low, and a higher low. So that looks really good as well. Let's take a look at the QQQ, which remember the Qs, which represents the Nasdaq. This has a low, lower low, and then a higher low. It looks like the bottom has been put in short term. We have a 340 point of control level, which is from that last kind of platform that we broke down below. So we should get a little bit of a rally. The key level here, anything above really 295 would be a positive close to the week. But a close above 315 or next week or this week would be also extremely positive. Let's take a look at AMZN. Amazon has been off to the races lately, kind of consolidated down here at the low 100s, and now it's kind of broken out to the upside. They do have earnings coming up, you know, in the near term. We had Alcoa had pretty good earnings. They gapped up and faded. But Alcoa probably has some good headwinds in the future because they're a big copper producer, and I think copper prices are ready to bounce. They also, you know, mine a lot of other materials. They got, what else do we have? XOM. Certainly XOM has put in a kind of a floor from the pullback. It made a huge run, obviously, when gas prices were rocketing higher, but now it's kind of put in a floor. This might be a really interesting level for ExxonMobil. We got, let's look at USL, right? USL kind of put in a floor here, level up, potentially another level up. But oil looks like after that really significant pullback that we might be getting ready to start to move higher again. This is US oil prices. UNG, which is natural gas, already ripping back to the upside. We got gold. Now, gold is an interesting one because it's really at lows, but gold is ready to probably rally. The US dollar has been on a tear. In fact, the dollar is at parity with the euro, that makes gold generally weaker, although it's kind of hit the point where this is probably a good point to start looking at gold and silver again. SLV. There's silver. There's the low here. There's silver. So far, so good for gold and silver. Let's take a look at GBTC. Bitcoin finally coming back to life, moving off its lows. It got a little bad news yesterday with Tesla having sold 75% of its stake in Bitcoin. They were holding a lot of cryptocurrency, but now they're not. ETHE is Ethereum. Ethereum made a big rally off the low. So it looks like cryptocurrencies are also trading with the markets coming off their lows. So, I mean, from a technical perspective, everything looks good for a potentially strong technical rally off the lows. We'll see if that continues for sure. But that is something that we should definitely note, that as long as the Fed doesn't give us a surprise, an upside surprise at 100 basis points, I think that is a very good chance that we could be in for at least a few weeks of summer rally, regardless of what else happens. And that brings me to updates. Stay up to tune with anything DAS by signing up to our monthly newsletter and emails. Simply fill out the form at the bottom of the webpage at www.dastrader.com. Subscribe to our YouTube channel, DAS Trader TV, okay, and the DAS Newsroom reminder. Follow us on social media. That's LinkedIn, Twitter, Facebook, and Instagram. Everybody have a wonderful weekend. Let's stay tuned next week to see what the Fed decides. Trade well, everybody. Have a wonderful weekend. Bye-bye.